Hello, investors and future investors. Welcome back to the channel. For today's video, I'm going to show you an option strategy that can be used if you're trading with a small account. Now, if you're new to options and you're trading with a small account, let's say if between $500 and $1,000, then this video is for you. Welcome to Investment Gains. Let's jump right into it. Welcome back, investors and future investors. My name is Tim, and on this channel, I show you how I use my portfolio in order to make consistent income. For today's video, we're going to be going through an option strategy that's going to be working perfect if you're trading with a small account. Now, you guys know how we do it. We like to get down and dirty with options. So for today's video, we're going to be using Invesco QQQ. Now, key note, always make sure to do your own due diligence before investing. No one knows what's right for your portfolio more than you do. That being said, we're going to go ahead and we're going to go to trade QQ options to the bottom. Now, I did say this option strategy is going to work if you're trading with a small account. So bear with me. You won't be disappointed. Now, firstly, what we're going to do, we're going to go ahead to sell, because on this channel, we focus mainly on selling options in order to get consistent income. So by selling, we're always going to be receiving a premium. So now we're going to go ahead to put. Now we're going to go and choose our strike date. And for purposes of this video, we're going to be going with January 10th, which gives us about 6 days to expiration. Now, in order to make this strategy the most effective, it's highly advisable that you choose your strike price below the current share price. So below the current share price, now we're going to go ahead and we're going to choose a chance of profitability. So as you can see here, it's a chance of profitability. All these icons here can be switched up. You just click into the edit button and you could go ahead and switch it up if your screen does not look like this. Now, for this option strategy, we're going to go with a pretty high chance of profitability, and I'll explain to you why as the video progresses. So the chance of profitability I will be going with is going to be the 80% chance of profitability, which is pretty high. Now, with the 80% chance of profitability, that's going to give me a strike price of $509. If you look to the top, you're going to see strike price written right here. So with a $509 strike price and an 80% chance of me winning this trade, I will be paid $1.69. Now, $1.69 in the real world is going to be $169. Each option contract is multiplied by 100 shares. So we're going to go ahead and we're going to click into this. And as you guys can see here, this is a cash secured put strategy. Now, I did say this video is going to cater to small account options, so bear with me. So this cash secured put, if you were to do it right now, you would be trying to pick up 100 shares of QQQ at $509. So in order for you to do this option strategy, you're going to need $50,900 in your portfolio. Now, all you need to do to trade this growing stock, which is also a good stock, this is the QQQ, is highly invested in the technology sector. All you need to do is make a small tweak to your cash secured put. So here's the small tweak we're going to be making. We're going to go ahead and we're going to go to buy right now. And we're going to remain on the put side of things. We're going to maintain our exact same strike price. Now we're going to go ahead and we're going to choose our new strike price below our previous sell strike price. And now that we're going to be buying a put, now we're going to have to pay $1.52. Once again, that's going to work out in the real life as $152. Now, the difference between our sell put, what we receive for selling this put, and the buy put, the amount of money we have to pay to do this strategy, that difference is going to be our premium. So that difference right here is going to be, let's go ahead and hit continue, is going to be about $20. Now, this option strategy is going to be the put credit spread. Now, let's go ahead one more time and we're going to hit review, and I'm going to show you why this is perfect. So if you're trading with a small account. Now, in order for you to do the put credit spread, you're going to need to leave a collateral. The collateral for this is going to be $100. Like I said, perfect for if you're trading with a small account. Now, what Robinhood is going to do, or your brokerage account, they're going to keep this $100 unlocked until the expiration date. And then that's going to determine what's going to happen to this $100. Do not worry, I'm going to explain that to you as well. Now, once again, once you do this good credit spread, you're going to be receiving a premium right away. And this premium you're receiving here, that's what's going to help you to grow your small account. Now, the premium here is $20, which does not look like a lot. I've been there. I grew a small account. This is why I'm at where I'm at right now. I know how it feels. $20 is not much. However, don't look at the actual monetary value. Look at your percentage gain. So if you divide your $20 by $100, that means you're going to be making 20% once this trade goes in your favor. Just as a comparison, the S&P gives a return of about 10% annually. With this option strategy, you stand to gain 20% on a weekly basis. So there you go. Now, there's a couple ways in which this trade could go. It would be remiss of me if I don't tell you the pros and cons of this option strategy. So once you're trading with a small account, you always have to take on a bit more risk than someone trading for bigger account. That being said, I'm going to show you how to minimize your risk right after I show you the two ways in which this option strategy could go. And I will also add a third way which this option strategy can go. So come expiration date of January 10th, if QQQ is going to be trading at any price above the 509 strike price right here, then we're going to go ahead, we're going to keep our $20. Remember, I did say that's yours to keep no matter what happens. And then now your $100 collateral is going to be released back to you. You could use that $100 to go ahead buy ice cream. You could do the trade again. That $100 is back in your portfolio for your personal use. Now, the other way this trade could go, once again, come expiration date of January 10th, if QQQ is trading at any price below your 508 right here, then once again, you keep your $20 premium, but this time you're going to lose your $100 because the trade go against you. Now, your overall loss is not going to be $100. Your overall loss is going to be a net between $100 minus the premium you receive, which is going to be $80. So when we initially did this option strategy, I showed you guys that there's an 80% chance of profitability, meaning that there's an 80% chance this trade goes in your favor. With an 80% chance of this trade going in your favor, it stands to reason that there's a 20% chance that this trade goes against you. So always keep that in mind as well. Now I'm going to show you how to reduce your risk even further. So the reason why you had to leave $100 as collateral is because this trade is what's called a $1 wide spread. So the difference between 509 and 508 is going to be $1. Once again, each option contract is multiplied by 100 shares. Hence, your collateral worked out to be $100. So in order for you to reduce your risk with this option strategy, we're going to deselect this and now we're going to go down just a bit more. Now, your option collateral has now changed and it's now went up to $200. Now, let's go back just a bit because this is not a representation of the actual credit you're going to be receiving. So let's just go back so you can refresh yourself. And then we're going to go to review order once again. And there we go. So now that your overall risk has been reduced, and I'll explain to you why it's reduced, your option premium went up a bit. Now, let's go ahead and show you how you reduce the risk on this trade. So initially, if QQQ were to break your 508, then you're going to lose your $100. But now QQQ has a lot further to go in order for it to lose the trade. So it has to go past your 509, your 508, and now 507. So you increase the probability of the trade going in your favor. Now, most option traders go with a $5 widespread or a $10 widespread. That is all going to be based on your own personal preference and your portfolio value. Now, if you're trading with a portfolio size of $500, it does not make much sense to go with a $5 widespread. The reason for that is because your collateral is going to be $500. And if the trade goes against you, then you blow up your small account. So once again, always do your due diligence before investment. and take risks that's in line with your personal preferences. Now, I did mention that there's a third way in which this option strategy could go. So, once again, come January 10th, at expiration date, if QQQ is trading at any price between your 509 and your 507, well, once again, you already guessed it, you're going to be able to keep your option premium. But now you're not going to lose your entire collateral. So let's just say, for argument's sake, that QQQ is now trading at 508. Then now you're going to get back part of your premium, which is probably going to work out to be like $100. So that's the third way in which this trade could go. Once QQQ lands at any price between your two width, then you're able to get back more of your collateral. So the put credit spread is an excellent option strategy to help you grow your small account portfolio. Because you're trading with only a few dollars, you're not able to do the trades that you can do with a bigger account. All you need to do to get into these stocks is make a slight tweak to the big option strategies. In this case, it was a cash secured put. We made a slight tweak in order to protect us on the downside. And the result of that, in order for our troubles of waiting 5 days for this trade to expire, we were able to receive a premium. With receiving your premium, you're going to need to leave a collateral. Your collateral is going to be based on your own preferences. Like I showed you, you could go $1 widespread, $2 widespread, whatever suits your fancy. So if you were to continue doing this option strategy and taking an 80% chance of profitability, you're going to win this trade 4 out of 5 times. Do the math. 4 divided by 5, 80% chance. So just ensure once you leave your collateral, you not put up your entire portfolio as collateral. I have been there. I have done that. So I do not want you guys to make my mistakes. Now, if you found any value in this video, go ahead, like the video, subscribe to the channel. If you guys are interested in joining the weekly income team, then it's going to be the first link in the description below. Also, if there's anyone you think can benefit from this video, if anyone is struggling in order to grow their small account portfolio, feel free to share this video with them. And until the next video, keep pushing your small account.